Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back. Hey, first of all, I wanted to say thanks to everybody that came out on Thursday night. It's always a lot of fun for me anyway. Hopefully a lot of people had fun there too. And I did tell everybody I was going to do a raffle, and I have everybody's card that came, so I'm going to actually pick that. This computer didn't come in, so I don't know what's up. I'm going to tell on HP because those guys have been really slow. They were 6 months late delivering my office computers. That really bothered me. And now they're, these things haven't come in on time. So I don't know. They business must be really good at HP to be delayed that much. But anyway, we're going to do the drawing. I've got all the cards that everybody had turned in. And we will be announcing that next week, so if you want to stay tuned. And I'll send out a little email to everybody that came to notify them of who the winner was. And we'll probably do that, from now on. I think they've gotten so inexpensive to do Chromebooks or computers. And it used to be people would save all their statements and put them in a big binder or several binders. And now I think if you just have a little inexpensive laptop that you keep dedicated towards your financial stuff, that might work too. In fact, with the things that we do, it's, I think it's perfect. You've got everything stored. You can make copies, keep it online. That's kind of a big deal. So I think it works really well. And I want to kind of continue the conversation that we'd started a few weeks ago and talked about at the seminar. That's basically how to put together a retirement plan. That's one of the things that we get paid for as financial advisors, investment managers, is to do some basic planning. And the basic planning is really all most people need. I mean, there are, if you've got millions of dollars in businesses all over the world, you're probably going to have some accountants that are going to help you with that. The vast majority of us don't really need a lot of that. In fact, the basic retirement planning process is relatively simple. You just have to figure out how much money you have or how much money you think you'll have, how much in income you're going to get from Social Security or pensions, and then you're basically done. That'll tell you what kind of an income you can hope to generate. Well, I shouldn't say you're done. Then you have to figure out how much risk you want to take. And I've got a super simple process. Now, I use Morningstar for this, by the way. You answer about 6 questions. Those questions are fairly difficult to answer. So I have one overriding question. It's actually, in my opinion, it's better than their 6, but theirs have been approved by the U.S. government. So I use both. But here's what you can do as an individual. So we need to know how much in savings you'll have for retirement. We need to know what kind of income you'll have. And we need to know what kind of risk taker you are. We get those 3 questions answered, we can design the program. And here's the risk question, the simple one, that's actually better than the one that you're going to get from Morningstar or Fidelity or Schwab or any full service firm, is essentially, how much of a decline in your portfolio are you willing to tolerate? How much of a decline in your portfolio are you willing to tolerate? And when you get that number, and let's say you've got, $500,000. $500,000 and a 10% decline, 10% of 50 of $500,000 is $50,000. You'd be down to $450,000. Are you losing sleep? If you're losing sleep over that, then you need to cut it back to maybe 5%. I'm going to tell you something. If you're not willing to put up with a significant amount of fluctuation, you're probably not going to make much money, because CDs and bonds, safe ones, are not paying a lot. CDs aren't paying much. Stuff that's safe where your principal is guaranteed are not paying very much. So if a 10% decline sounds good to you, I'm just going to tell you your average annual return is probably going to be somewhere around 2% if you're really good. Think about that for a second. 2%. You know what 2% of $500,000 is? 2% of 500,000? It's $10,000. That's before taxes. After taxes, you're probably going to be left with $8,500. Okay, and if you can live on $8,500, by all means, go into something that's completely secure and safe, like a treasury. Okay, but if you can't live on that, then you're going to have to put up with some risk. And it's unfortunate that you can't just lock everything away and guarantee it. And I know there are a ton. If you're talking to people that are talking about annuities and they're guaranteeing a rate that's higher than 3%, I'm sorry, they can't do that without increasing the amount of risk. It's impossible, no matter what they say. And I'm going to give them the benefit of the doubt. The people that you're talking to that are telling you that you can get these big rates, big bonuses up front, they just don't know any better. I'm going to give them the benefit of the doubt. They don't know any better, because if they did know any better, that means they don't want you to know what they know. And I'm just assuming that they're probably good people being misled by some crappy insurance companies who put out some marketing material to sell stuff that's not what it appears to be. And they're out there. They are out there. There are thousands, a couple thousand minimally, insurance companies that sell those types of products. They're not all good. Some of them are extremely good. Some aren't. And if it sounds too good to be true, probably is. You just have to be extremely careful. If you've got annuities, by the way, we'll do an evaluation for you. You want to send it in to us? You want to schedule an appointment to come in and bring it in? We'll go through it together. I'll show you what to look for. I'll show you what the good ones look like so you can tell the difference. If you've got an old policy out there or annuity contract, you want to review it, you're thinking you'd like to check around to see what other options there are, give us a call. Go to our website. It's a big deal. I use an investment-only annuity. Now, I used to use various types of annuities that would guarantee certain incomes or guarantee death benefits. I stopped using those when the expenses got too high that I didn't think you'd be able to keep up, that the investments wouldn't be able to generate enough return to pay for those expenses and have a lot left over for the client. So I stopped because they changed. They're not the same as they used to be. And some of them are still out there. In fact, this is, talk about bringing up old memories, a company called AXA, insurance company. It's a French company. They tried to go public. The demand for the stock was so low that they had to drop the price significantly. Think about that for a second. Companies coming public, you know what happens with IPOs? Everybody gets all excited. Okay. Yeah, well, they were so excited about this one, nobody wanted to bid on the price that they were offering. So it comes in a lot lower. Why? They have variable annuity products. They have other annuity products, and they're not making very much money on them. In fact, that's a big portion of their business. That's the history of that company, by the way. They're trying to do too much. I mean, it's kind of wild, actually. They're trying to offer things and to provide things that they just can't. And it's not their fault. They've got actuaries that try to help them calculate what they think they can pay. And when the actuaries are overly optimistic, this is what happens. And the same thing, I don't know if you've been reading the journal or not, but just a few days ago, most of the big pension plans around the country, they actually named a couple local that I'm not going to name again because I don't want to hear from their attorneys. But the bottom line was there were a lot of public pension plans that had estimated that the returns were going to be higher than they came in at. And now they're going to have to do something about it again. They're probably going to have, the people that are contributing now are going to have to contribute more and are going to be expected to take less. And because the people that are already in there, they were guaranteed. Those are contracts. They can't go back on those contracts easily. It's expensive. They want to avoid getting sued. So this is what's happening. They're reducing the projected benefits for the persons that are contributing today. They're still pretty good, by the way. That's the funny part. They're still pretty good. They're just not as good as they thought they were going to be. And when you plan on making 15 to 20% more than you made, and you estimated that that's what you were going to pay out, it's a problem. The problem, fortunately, has fixes. The same types of fixes that have been going on. The people that are participating today are going to have to contribute a little bit more, and they're going to have to take a little bit less when they retire. That's the solution. Same thing with Social Security. We'll be contributing more, and it's probably not going to keep up with the true cost of inflation. When you're retired, incidentally, and this is something I haven't heard a single solitary soul. So if you are a PhD candidate looking for a topic for your thesis, here you go. Thank you. No, you're welcome. Not thank you. You're welcome. So retirees, we're getting ready to retire. You could do this if you're an economics PhD candidate. You're looking for a thesis? Here you go. The inflation rate of older people is significantly higher than the inflation rate of younger people. Why? Because when you get old, your body starts to wear out. I'm living proof. We all are. Anybody that's old enough to have an AARP card knows exactly what I'm talking about. And the cost of inflation in healthcare has been triple the regular inflationary expenses. It's gone up about 3 times faster. So if Social Security is only going up at a rate that's not quite the equivalent of the lower rate that they project, that's not age-weighted, that's what I'm going to call the term. It's age-weighted inflation. The age-weighted inflation is much higher than the actual inflation rate, and they're only using a portion of the actual inflation rate to inflate the Social Security payment. So, in other words, you're just not keeping up. That Social Security payment's not buying as much as it did 4 or 5 years ago, and that's a trend that's probably will continue. Why? Because it can't keep up. Because they also underestimated how long people would live, and how many people would continue to survive. The mortality rates have all improved. That changes everything. So these are the types of things that they have to do. That's why the retirement planning process is really not that complicated, by the way. You're going to come up with a ballpark estimate of whatever you think you can live on. If you can't come up with a number, I see this all the time. Well, I don't know what I need to live on. Well, what are you spending now? Well, what's your salary? It's blah, 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 blah. Okay, well, let's just use that. Okay. And by the way, if you don't know what that is, now there's something really wrong. If you don't know what numbers you get on your paycheck or how much money you earn, that's a problem. But if you have an idea of how much you are earning or how much you would like to be able to live on, that's relatively simple. Now we're just going to adjust that for inflation. You tell me approximately how long you want to work, how many years you want to work, and I can tell you pretty much how much money you're going to need to accumulate to withdraw somewhere between 4 and 5% a year, and to be able to last for at least 30 years. And if you do it well, you never run out of money. If you do this really well, you don't run out of money. You leave money behind for your beneficiaries, charities, kids, or grandkids. That's the way it really should work. So for that, all you really need to know to do your retirement plan, how much money are you making now? How old are you? Do you know how old you are? That's a tough one, isn't it? I'm kidding, obviously. But you need to know how old you are, how much money you've got saved towards retirement now, and what kind of lifestyle you want to have. Then you need to look up your Social Security or any other pensions that you might get. You get that stuff together, and we can pop that into some software, and it'll tell you approximately, based on how much risk you want to take, it'll just pop out a number, lickety split. Not that hard to do. If you wanted to do it without a calculator, I'll have to actually devote an entire show for that. But it can be done without a calculator. You can figure out how much money you need to generate to be able to have the lifestyle that you want to have at whatever age you are. I'm going to be real candid on this. Most people have misconceptions about a lot of different things when it comes to this. Talk to people all the time. Well, the stock market's average 10% a year, so I'm gonna bet on 10% a year. Really? Stock market's also been down 50% multiple times. That means you have to watch to see your money be cut in half. And you better not be pulling out 10% when it's down 50%, because you will run out of money before you die. So that's just one of the things you need to be aware of. There's no need to panic over it. In fact, the average retiree, I'm just talking average, large numbers. Average retiree, to maintain their portfolio, to supplement their income, needs to be 50% invested in stocks in some way, shape, or form, hopefully an organized method, like a fund or a series of funds. You need to have at least 50% of your money invested that way. And which means that if you had 50% of your money invested that way, you have to have a risk tolerance of about 25%. What do I mean? Well, if you've got 50% of your money in stocks, and stocks get cut in half, they go down 50% the way they did in 2000, and then again in 2007 through 2009, 18 months. If they were to be cut in half, and you only had 50% of your money invested, you'd only be down, assuming that the other 50% is invested relatively safely. Safe, by the way, we'll have to come back to that. We're talking about relatively short-term bonds. And there are a lot of quote unquote safe income yielding investments that aren't very safe. We'll talk more about all this stuff when we come back. Listen to Bill Bullington right here on 1420 The Answer.
You give me life everlasting. Your promise deep in my soul.
And we're back. Hey, I just thought I'd let you know it's 216-901-0945, I believe is the number for the radio station here, WHK 1420, The Answer. And actually, there are lots of answers to lots of questions on this station. So if you'd like to give a call, please feel free to do that. If you'd like to call me and set up a little meeting to go over some of this stuff, retirement plan, with the software we have today, it's actually astounding. I mean, it's amazing what you can do in 4 or 5 minutes. So all you need to know is what your age is. You need to know what your income needs to be at retirement. And some people, if you're struggling with that, just take whatever you're making right now. Just start with that. And you need to know how much in savings you have set aside for retirement. And that's about it. You got those 3 things. We can actually pop out the plan, and then you can see what you need to do, how much risk you might need to take, how much increasing your fluctuation tolerance a little bit might help your ability to save and earn for retirement, and all that stuff with just 3 little pieces of information. How neat is that? By the way, that's just because the software is so good now. The software has really improved dramatically over the past 30 years, since I've been in the business anyway. And if you're already in retirement and you're spending, you can get an estimate of how much risk you might need to take. Maybe you're taking too little, maybe you're taking too much to be able to generate the income off of your investments the way that you'd like to. And all of this is predicated on basically how much money you have in stocks versus bonds. And we're assuming, when we're making assumptions, we're looking at long-term averages of indexes, not necessarily the things that you're investing in. We're hoping that you come close to the index, and we can factor in things like management fees and taxes if you'd like to. But I think it's really interesting that you can do this so quickly now. It blows my mind, actually. And it's just not that hard. In fact, I might even maybe in the next commercial break, I'll work up an example. And so if you have any questions like that, again, feel free to give us a call, talk to us about it. It's basically the specialty at Bullington Capital. I mean, everything in my mind, all financial planning was to basically plan for the day when you were too old or just too tired to go to work anymore, and you didn't want your lifestyle to drop because you quit working. That's what I ultimately felt the goal of financial planning should be. Now, there's a lot of stuff out there that tells you, oh, no, you should be more concerned with your credit card rates. Really? How about this? Just pay your credit card off every month. Don't accumulate debt on a credit card. They charge as much as the mafia does. That interest that you're paying them could be money that you're sticking in your pocket. So that kind of stuff, I always thought it was kind of common sense. Just pay that off. Have a pretty good idea of the type of income that you need to have personally. And if you're struggling with that, just take whatever you're living on now. Now, for some people, that's going to be really, really tough. It depends on how old you are. But the younger you get started, by the way, the easier this is. And as you get closer to retirement, if you've accumulated any assets, it's because you already knew these things. You're already doing them. And maybe you're questioning, how much longer do you think I can actually live doing this? Or a lot of other questions. I've got a couple calls coming in right now. If you'd like to call us, 216-901-0945, 216-901-0945. And I can go right to Chris. Chris.
Hi. How you doing?
Good. How are you?
Good. Hey, I just want to get an opinion on a stock last week.
You're coming in and coming out. I can barely hear you.
Oh, I'm sorry. I'm in a basement here.
Okay.
How's this? Is it better here?
It sounds like it's a little better.
How's this? Is this better?
Yep. Yeah, that's a little better.
Hey, AT hit a 6% dividend last week. Stock or 6.2. Isn't that much risk in this stock at this dividend? Is that high?
There is an enormous amount of risk in AT&T.
Okay.
An enormous. AT&T is one of those stocks that their businesses are all under massive disruption. Now, I don't think AT&T is going to crash anytime soon. I just think that that the road ahead for them is unbelievably difficult. And I would not want to be the CEO of AT&T, other than the fact that he makes a whole lot of money. And it is a he, by the way. But
what's the difference between that and Verizon? Seems
nothing.
Like AT&T. Okay.
They're both.
So
They're both.
they both have,
yes, and you can thank Google for this.
okay.
There's some technology out there that Google already has a massive head start on these guys on. And it's going to change the cell phone and telephone and cable. It's going to combine them into one service. And Google is ahead at this stage of the game. Do you remember a company called iOmega? They made a floppy disk that was...
Yeah.
Okay, yeah.
Well,
while that was so hot and everybody was going, oh, how do you like that? How do you like that? I'm like, have you ever heard of a CD-ROM? And people are like, no. Okay, well, you might want to look that up. And here's what I'm telling you. You might want to look up 5G because that is a game changer, and the technology is changing, and it's a threat to every cable company, every phone company, every cell phone company, and every internet service provider, and every radio station and television station, by the way.
but don't they have the 5? Who's doing the 5? I thought Verizon and AT&T were the ones rolling out this 5G technology.
They're behind.
Okay.
And they're going to be spending lots and lots of cash to catch up. And they've got a bunch of divisions there. They all do a ton of things now. And it's just really, really difficult. I mean, look at AT&T's revenue last 12 months, $160 billion. It's down a little over 3% from the year before. That is that is a lot of money up for grabs. And it's up for grabs. Their markets are up for grabs. The new technology can bypass the telephone, and they don't even have to go to the FCC for that. Think about that for a second. That's never been that way. So I'm not I'll own these stocks when they come up in one of the models I have, because the models are limiting the exposure to those stocks, and AT&T's in there right now because its dividend yield is high. At some point in time, AT&T's probably not going to be in there anymore. Yeah, I'm just telling you that from a logical standpoint, that the road ahead for them is tough. That is a really difficult place to be in. But yeah, I own the stock. That doesn't mean I'm in love with it. I've learned that
this Time Warner thing coming up is nobody knows what the hell the
government do. And that's just the beginning. The reason that they're trying to band together, to put those two companies together, is because they see the writing on the wall. That whole business is changing.
Yeah.
And a whole bunch of other businesses are going to change because of that technology. It's pretty wild. It's interesting. Yeah, but I don't know. So AT&T only makes up a little over 2% of one of the portfolios I run. So it's not going to kill me or make me rich. You know what I'm saying? It's not going to. It's in there right now because the dividend yield's very high. If the dividend yield drops, or they start losing or don't have positive cash flow, the stock will be gone. And but for now, it's a part of one of the portfolios. So I'll own it as long as it continues to meet the criteria. Once it's not met the criteria, it's going to be gone. But as far as trying to predict what it's going to do, I have no idea, other than I look at what they're facing and I go, wow, that's tough. That's a really tough thing to have to face. But they do have got a lot of revenue.
Yeah.
So
okay. Well, you look at these things and it's like, I hate to say it this way, but you got to believe AT&T will be around.
Well, yeah, some people thought, that GE would never come down either.
Yeah,
some people thought that IBM was gonna rule the world forever, and Walmart, and JCPenney, and Kmart, and Sears before them. I'm telling you, the world is filled with places. Enron was the biggest public utility in the country. It was one of the oldest, one of the most successful. Times change. That's why I think you've got to have some sort of methodology that you're following, other than just your gut feel and instinct and what you can read in the papers, because it's just not enough. You need more than that. And it's fun to
Google. Other than Google, who else is out there?
Oh, there are a lot of small players. Google will just gobble them up, though. That's what they've been doing. Remember how Cisco used to buy all those companies up? Very similar. But anyway, I got to run.
Okay.
But thanks for calling. Yep. Have a good day. And I got to go to. Hey, Dan, is that you?
Hey, good morning, Bill. How are you?
Hey, pretty good. Good.
Hey. Oh, I was just. All right. Here I am. You caught me in between. I was on. I thought you were talking to him for a little bit longer.
Okay.
Sorry about that.
Oh, no problem.
Hey. Kind of called to talk about the Cleveland Grays Cornerstone celebration on June 2nd coming up.
Right.
And like we did last week a little bit, we're getting more and more people signing on to it. The Cleveland Grays is in downtown Cleveland. And we've been in Cleveland for 180 years.
Yep.
And our building is at 1234 Bolivar, and we've been there for 125 years now. And so we're going to have our Cornerstone celebration, 125th celebration, and more people are signing up to be sponsors and setting
awesome.
up displays at the Cleveland Grays downtown Cleveland. One of them, which you might find pretty interesting, is the Federal Reserve Bank of Cleveland Money Museum.
Oh, nice.
is going to set up a war bond exhibit.
Huh. Oh, yeah, that'll be really cool. That's
Yeah,
awesome.
so we're signing up more and more people. We got the USO, the National Guard's coming. The Western Reserve Theatrical Organ Society will be performing with their Wurlitzer organ at the Grays that day. We'll be doing tours of the building. Now we got the Federal Reserve coming. We're going to have a cultural area for heritage activities and crafts.
Right.
And the USS Cod is going to be down there. And we're going to also be taking donations to send over for troops that are deployed right now. So if anybody wanted to bring stuff, canned goods, clothes, socks, because we're doing the socks for the homeless veterans also at the Cleveland Grays that day,
Okay.
which you'd be surprised how important that actually is.
Yeah.
You know, donating socks, for the homeless people, and it's for the homeless vets. But any items that you have, we're going to send over, the troops that are deployed. We're going to be having that going on. And also, if anybody, when they come, if they have flags for retirement, we will take them and retire the flags that are ripped and torn that people don't know what to do with when they display their flags. We will also be having a station for that also. So each week, it's more and more people are signing on to us, and it's coming along great.
That sounds good.
So you can hashtag us at Downtown Castle also. So Downtown Castle is our hashtag, and GraysArmory.com. You can look us up online. But that'll be June 2nd. And we'll be doing free open house, and that'll be from 12 to 4, and we'll be doing tours through the building, too.
Yeah, and those are, I'll tell you, that's for something that's free, you can't beat it. It's a lot of fun. There's a lot of history there. The building itself, if you're a fan of construction and architecture, the building, it's worth going down just to see the building. So,
yes, it is. Yes, it is. And and everybody always wants to know what's that castle-looking building there on 14th Street across from Playoff. That's us. That's the Cleveland Grays.
You know,
So,
when I was a kid, I worked with my father, and we worked all over the city of Cleveland, remodeling homes, a lot of really old homes, and we would pass that every once in a while. And I was almost afraid of it when I was little. I thought that looks pretty spooky, but then as I got older, I was like, oh yeah, that's pretty neat. And it is. It's I think it's one of the best, coolest buildings in the entire city of Cleveland. So
yeah. And a couple other ones that are going to be down there that are helping us are the Early Settlers Association from the city of Cleveland. The Historic Gateway Neighborhood Corporation is giving us a hand down there.
Oh, nice.
Soldiers and Sailors Monument. So this is rolling. Every week we're getting more and more people involved with it. So I would really like to extend the invitation out there for people that mark it on your calendar, June 2nd from 12 to 4.
Right.
And we have our own parking on the west side of the building.
Yep.
So it'll be a good time. Come on, come off.
Yep.
But I thought you'd really get excited about that war bond exhibit with the Federal Reserve Bank of Cleveland.
Yep. I'm definitely going to go and spend some time at that one. That's cool. And I'll just let everybody know again, you can go to graysarmory.com to learn more about everything that Dan's just been talking about. And it's Grays. Yeah, and it's spelled GraysArmory, Grays Armory.
Yep. GraysArmory, oneword.com, and you can hashtag us at Downtown Castle.
All right, cool. Well, hey, thanks for calling again. I hear the music. I got to take a real quick commercial break.
Okay.
I'll talk to you
soon, Billy.
Sounds good.
Thank you very much.
Yep. Listen to Bill Bullington right here on 1420 The Answer. Stay tuned.
The bottom of the ocean blue. I'm a brand new man in a foreign.
And we're back. I'm going to go right to the phones. You'd like to call us 216-901-0945. And Jerry, how you doing?
Good morning, William. Okay, the gentleman who called 2 times ago was speaking about AT&T. I would assume that pretty much everything he said about AT&T would be also true about Verizon, correct?
Right, yeah.
Okay.
I'm glad you called. I have a really good idea for you.
Okay. okay.
You know how you like to do the buy right thing and sell both puts and calls?
Yeah, sure.
Well, I own Procter & Gamble, and that's what I'm going to start doing. I'm going to start writing puts and calls, because what happens then is the premium that you get for the put and the call, you can add to the price and take away from the price. You know, so let's say I get, I don't know, $3. So the price right now is $3. I'm $73. So I'm profitable all the way up to 76, or all the way down to 67. So as long as it stays in that range, I'm profitable, and I'm going to get the dividend, which is close to 4% right now.
Well, okay. In a trader's vernacular, is that called a strangle?
No, it's a combination.
It's a combination.
Yeah.
Okay, I was just wondering if there's anything. But okay, moving on. I have 2 stocks for you this morning that I'd like you to.
Wait a minute, I got one
give-
more
give-
other. I got one other thing
okay.
to tell you.
Go ahead.
So there's this guy comes to my seminars. His name is Joe Waterman. He's got a meetup group. He was a floor broker for a major institution on the Chicago Board Options Exchange.
Okay.
He's got
Very
some really, really good ideas, and we're going to team up. I'm going to give him the stocks, kind of like the idea that we're talking about today. He's probably listening. He's probably going to be doing something. His are more sophisticated. He does a lot of really sophisticated stuff, but he can tell you what the risk is, what the potential gain is, what the possible outcomes are, and it just rolls off the top of his head because he had to do it so much down on the floor.
Sure.
So
This gentleman's name is Joe Waterman?
yeah, and you can find him if you go to meetup.com. He's teaching these courses now.
Okay.
And what I'm thinking is there's this model that I like to use at Bullington Capital, where I look at the enterprise value and I divide into that the operating income to give me a yield when I'm looking for attractive stocks to buy. And this would be a really good strategy for the combinations that we were just talking about. If it's a good stock, I don't mind owning more. I don't mind owning more of it if it drops a lot. If it's a good stock and I want to get a dividend plus all that premium for the options, that's pretty good.
Absolutely. Okay, first stock I have is kind of fallen. It has fallen from grace. It's paying a decent dividend of about 3%. It's close to its annualized low, which I tend not to like to buy them when they're super cheap, unless they're dirt cheap, if you know what I mean.
Yep.
But Newell Brands, what's your thought on that?
Hang on a second. To look that up.
It's taken a good whooping. As I said, it's paying a solid dividend. It's the kind of stock I wouldn't mind owning if it falls a little further, so I might sell some puts against it.
Well, on I'd probably sell the put and the call.
Okay.
Because on a fundamental basis, the stock is pretty cheap. You look at the price to sales ratio; it's 0.9. Newell Brands makes a bunch of plastic stuff for all those people that don't understand what it is. But there's not a lot of profit margin in that anyway. Typically, you look at their average margins; they're probably somewhere around 4 or 5% net after tax, which is fine. And that would be right around. That would put it right around where the current price is. So when it was up at $47, $48, it was actually overpriced. Now it's right around where it should be. So if you don't mind owning the stock, you could do the buy right, where you're buying and selling calls. If you buy a little bit of it, let's say you just buy 100 shares, it's only $2,700. You're going to get a 3.5% dividend on it. If you sell a call premium, you're going to bump that up quite a bit, actually. If you sell a put saying, I don't mind buying another 100 shares, now you're really cooking with gas. And you can just keep doing that over and over and over. Of course, the share price is going to move.
Of course, it's a stock.
Yep.
Yeah, that's the word, right?
Yep. So, but those are that would be like the type of stock that I think is really appropriate for that type of strategy.
Okay.
Yeah, and when you're doing stuff like this, for all those listeners that are not have never done any of this before, go to a class before you do this, because you can get hurt really badly if you make a mistake. if you buy 1,000 shares instead of 100 because you fat finger it, now you got 27,000 shares of a stock. that could be bad.
That could be real ugly.
Yeah,
very, very ugly. All righty. I received a call from a friend of mine who's in the cybersecurity business out in California a couple of days ago, and he has turned me on to some nice companies over the past. One of them, he said that he feels is going to be pretty good. It took a nasty hit the other day. Was Symantec? They are an antivirus Norton company, so forth and so on. I bought a bit of the stock. I put a sell loss underneath it about 5%. I think it was 5 or 6%. It was kind of following. What do you think the long-term prospects are on that company?
I don't know. The trailing 12 months revenue. I saw that thing too, and I owned the stock at times. They came in with a nasty surprise. Stock was down 33% on Friday.
Sure.
But revenues were $4.8 billion. They're up almost 10% year over year. That's not bad at all. The market cap though is over $12 billion. So you got a price to sales ratio that's about 2.5, which is relatively low for the industry. But given the fact that the stock dropped so much on pretty bad news, you really can't predict what it might do over the next few months. That'd be another one that I'd be a little bit wary of it. I hate going into a stock right after a big move.
Sure.
Because the volatility levels are high. You could sell if you really liked this stock, though. I would probably sell the puts and the calls because the premium for the puts is going to be through the roof.
Right.
You get a lot of protection on the downside from that, and the calls, you got implied volatility. They're going to be not so much. Yeah, I would probably sell a call that might be just right at the money or slightly out of the money. And that's going to limit your upside, but the premium that you're going to get for selling that put will be pretty good.
Well, the thing that kind of concerns me, and that specifically, is the price-to-earnings ratio. I know you said not to get too worked up about that, but it's if you check that price-to-earnings, it seems very high at this point. What do you think?
Well, that's because the earnings are fluctuating. When they take a charge against earnings. Earnings is one of the least reliable numbers you can ever use. Let me say that really slowly. The earnings are the least reliable number.
Indicator, yeah.
Yes, because they fluctuate so wildly, especially in a really large company that's got a lot of moving parts. And every accountant on the planet's nodding their head right now. Anybody that's listening to that. So that's why the sales numbers, they're much more accurate, and the income from operations are a little bit better to use. There are improvements over using a price-to-earnings ratio. I will be honest, I never use the price-to-earnings ratio. I never look at it. And I rarely look at the earnings unless I'm doing my own calculation and comparing it to other stocks in the same industries. So I'm really looking at other things. How much income did they generate? What's the total cost of purchasing the entire business? And if I divide the operating income by that cost, now I get a yield. And that's the kind of stuff that these private equity firms are looking at. They want the biggest bang for their buck. Not to say that they don't make a lot of mistakes, because they do too. And that's just because there's so few really, really good deals that are big that they can, they can't leave the money sitting in cash. So many times I think they're just taking, they're swinging at bad pitches just because they've got to do something. And that's actually a problem. That's become a big problem in the past, 4 or 5 years. Central banks around the world have been pumping out money incredibly quickly, and there just aren't that many places for it. That's one of the reasons market cap weighting has done so well, because they don't know where to put the money. And it's going into those places because there's money printed, and it's one of the few places available that has liquidity, and they can get it back out really quickly. So you're on almost every level, large cap, mid cap, small cap, international emerging market, the market cap weighted indexes in those things have outperformed 80 to 90% of the funds in their category in the last 5 years. That's a little unprecedented. It would be unnerving for me if the valuations were really, really high, but they're not yet.
Right.
Yeah. So
Okay. I have one more question, if you could answer. It's kind of a observation. A number of the analysts are saying that the North American market, because it was so hot last year, is cooling down. That the emerging markets, the Japanese, Chinese, the over in Southeast Asia, the markets are. It's about time for them to become
hey, Jerry,
strong. Yeah,
I got to run.
Okay, very good.
Thanks. And Brian, I'm sorry I didn't get you. Get to call me in the office. I'll get you next week too. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Listen to our podcasts. This show is repeated on The Fish, 955thefish.com. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.